Hey, what's up guys? It's Ezekiel Chiu here. So, here's the thing. You're gonna cut through the noise. If I'm gonna start trading all over again, there's only one thing that I'm gonna use. It's the moving average. So you have probably heard the moving average like a million of times, right? But I promise you, you have never seen them explained like this. Most traders use the moving average the wrong way. I mean, they put it on the chart, they wait for a crossover, and they think that, oh, they have unlocked some secret formula. Wrong. If you actually want to make money in the markets itself, you need to think differently. So today, I'm going to show you exactly how I use the moving average in a way that 99% of the traders out there completely miss. There's no boring definitions, no complicated nonsense, just real actionable strategy that works. Ready? Let's go. What is the moving average, right? A moving average is a basic tool that calculates the average price of an asset over a certain number of periods. This isn't like some magic trend detector, alright? It's a tool, it's a guide. It's not deciding factor, right? So it's not about fancy crossover or chasing some laggy signals. No. Like I say, it's gonna be a different way of looking at it. It's about seeing where the market actually wants to go. So think of it like the GPS, right? The GPS. It would not drive for you, but it tells you where you are headed. For example, a 10 moving average looks at the average closing price of the last 10 candles. So this is like just the definition, right? So, but it's important for us to know that why and how a moving average works so that we can do it differently. It helps to smooth out the market ups and downs. So making it easy to see the overall trend. And that's the purpose of the moving average. Forget about the golden cross or the death cross. Here's what really matters. Okay, number one, the direction, right? The direction would equate to trend clarity. Here's the question. Is price consistently above or below the moving average? Right, that is the real question. Number two, the distance equals to the strength of the move. All right, the further price moves from the moving average, the stronger, or on the other hand, the weaker the trend. Number three, the bounce points. Price always return to the area of value. When you learn where it is and where it respects, you will have now laser focused entry points. Think about it like this. If you check the price of any vehicle like every day, let's say $1 today, right? And then tomorrow $2, the next day $3, the next day $4, the next day $5. You do not want to obsess over every single daily move of itself. What you really want to know is what is the bigger picture of the market itself. That's where the moving average comes in. So instead of focusing on just today's pricing, oh, today is what price? No, the moving average just smooths out the noise by averaging the last few prices. So in this case, what will happen is that you add up all the last 5 numbers, right? And then divide it by 5. This is your 5-day moving average. It's also like looking at your fitness progress. Some days you got bad workout, right? But that doesn't define you. It is the trend over time that matters. Moving average helps you to see the real direction of the market without you getting distracted by all the daily randomness. The next time you see a moving average line on the chart, don't overthink it. It's just a simple way to track the trend. This is what it is built for. We not get caught in the chaos. For example, let's say you got 5 prices, $1, $2, $3, $4, $5, and then you add them up, you get 15. So now you divided it by 5 because there are 5 numbers. So what do you get? 3. 3 is your moving average. This is telling you that the average price, this is the average price. 3 is the average price over this 5 period of $1, $2, $3, $4, $5. Okay? So that's where you don't get caught up with all this movement. This is the average price. It helps you cut through the noise and see the real trend. Alright, so before we continue, I wanted to share something interesting for those of you who trade or are thinking about it. So if you're into trading or are looking for a solid broker, XM is the one that a lot of traders rely on. So one of the things that stood out is how reliable it is. It is fully licensed and regulated, and there are no issues, man, when it comes to deposits or withdrawals. I mean, this is something that every trader look for. They even have 24/7 customer support in more than 30 languages. So no matter where you are, I mean, there is always help available. So another thing that really matters in trading is execution speed. So if a trade takes too long to process and you can miss out on the best price or end up with slippage, right? So with XM, 99.4% of trades are executed in under a second. That means what? No requotes, no rejected orders. I mean, just fast and accurate execution, which can make like a huge difference in your trades. And if you are looking to improve your skills, XM also offers trading competitions, right? So you can start with demo competitions to practice risk-free, or jump into the real ones to test your strategies in the live market conditions. I mean, it is a fun way to learn and get better at trading, right? So if that sounds like something that you will be into, check them out in the description below. Right, so now let's get back on. Let's say a new number appears, $10. For a 5-period moving average, we take the last 5 numbers. So therefore, it will now be the $10, $5, $4, $3, and $2. We add them up, we get what? 24. 24 divided by the last 5, because we are using the 5-period moving average, this gives us what? 4.8, which is the moving average displayed on the chart itself. The average of the last 5 values, the last 5 bars. So the main idea of a moving average is to look at the past prices and find the average based on how many days or periods that you're looking at. There are also many different types of moving average, like the simple moving average, exponential, and weighted, right? They are just small variations of how the average is calculated. But the main idea is still the same thing. It shows the average price over the set number of period. That you understand moving average. You can see why the average number on the chart goes up or down based on the previous prices. Many traders, they obsess over one single market itself, trying to force the trades where they think the opportunity is. The real money, you know where it is? It is in finding the strongest market that is already proving itself. And then you ride that momentum. A moving average isn't some random line on your chart. It is also a heat map for strength of the market, strength of that pair. The market that's climbing faster, breaking out cleaner, refusing to pull back, those are your winners, right? The one that's lagging, struggling to go up higher, or barely moving, leave that off. Let's look at another example. If price breaks above a recent high and then it hesitates, it's often what? Gearing up for another move higher. So instead of guessing, use the 50-period moving average as your guide itself. You compare the two markets with similar price action. Look at their distance from the 50-period moving average. The one that is further away isn't just moving, it is surging with momentum. And that's where the real opportunity is. Stronger momentum means what? Stronger trades, right? Trades, you got to trade where the market is pushing harder. So not just where it looks familiar. The price that is closer to the 50-period moving average, it indicates it is less distant away from the average price. So price may be moving more slowly compared to a stronger trend itself. If the price is above the moving average and is far from the moving average, it signals a strong market itself. If the market is below the moving average or is closer to the moving average, what happens? It suggests weakness in the market itself, indicating what? The market is not going to move so soon, that kind of stuff. It is best to avoid it. So this is how you can use relative strength to identify strong and weak markets. To time your entries better, avoid jumping in too late. On a chart, you often see what? Price staying close to or bouncing off the 50-period moving average. So this line highlights a key area where price tends to move up or down, right? Helping you to find a good entry point. The price keeps testing the 50-period moving average, right? And then occasionally breaking above it before snapping back, right? So in an uptrend, most traders see this as a clear signal to buy. But that's where they get trapped itself. A real breakout doesn't just take a peek above the resistance, it holds. So you want to watch for confirmation before jumping in. Before you rush to buy, you want to take a moment and think, why? If you want the best risk to reward ratio, don't chase the price. Let it come to you. So enter near the 50 period moving average. It increases the odds in your favor, giving you a higher probability setup where the buyers or sellers are likely to step in. Patience in this case, it's not just a virtue. In trading, is your edge in the market itself. So when price is making higher highs, it is important to not buy at these high levels. Right? Even though that price has gone up, chasing the market at this point can be risky. It is better to wait for a pullback before entering, right? Rather than you buying at the peak. A much more favorable trade location is to wait for market to retest closely towards the 50 period moving average. We didn't catch the first move when the market climbed up, but that's not the real opportunity. The real signal came when price starts to crack, right? Revealing what? A shift in momentum. So you want to trade as close to the moving average as possible. If you don't, I mean, you're playing really dangerous game, right? The market will surge away, it will lure traders in, and then after that, boom, it snaps back like a rubber band, right? It stops you out. So the smart traders will wait for price to come to them. Patience wins. So let me show you another example. If you notice, price often moves close to the 50 period moving average before making its next move, right? So this shows what? Price tend to return to the moving average as part of its trend. So stop chasing the price. It's a losing game. When price is miles away, like very far away from the 50 period moving average, and you try to enter there, you are gambling, right? You're not trading, right? It's like you're catching a falling knife. Let it come to you. Wait for the pullback. Position yourself smartly and trade where the odds are actually in your favor itself. So stop chasing price like everybody else. Instead, spot the area of value. If price pulls back near the 50 period moving average, this is your moment. Sometimes it can be the 30 or 40 period moving average. But the key is finding where price respect the structure. So enter as close to that zone as possible. So this way, your stop loss is a lot tighter, right? And your risk is lower, and your trade has now real conviction because you're trading in line with the trend for a massive reward. For example, if you enter near the moving average, right, you can set your stop loss just above it, keeping your risk smaller, right? If you compare to chasing the market and going short over here, your stop loss is now so wide, right? So by entering from an area of value, you will improve your risk to reward ratio, right? So this way, you avoid the large price drops when the market pulls back, right? So the moving average helps you to find this area and time your entries more effectively. It's pretty simple. Okay, take a look at this example. I use the 200 period moving average here as like a compass. So it tells you where the tide is going. You want to swim along with it. You don't want to swim against it. If price is below the 200 moving average, the market is generally in a downtrend. Think of selling, not buying. And if it's above, the trend is uptrend. Look for buys, not sells. It's a simple rule, right? Trade with the trend, not trade against it. So if price, like for example, it rallies up to a recent high while it is still below the 200 moving average, this is a time to buy or to sell. Now, it's an absolute prime area to go short. So smart traders sell when others get greedy. Here's another example. If price is below the 200 moving average, it shows that the market is in a downtrend. You look for short opportunities. You want to sell or you want to go short, right? So where do you sell? Where do you sell? Sell where the market struggles to go higher, right? So you want to watch for a recent swing high where the price kind of hesitate at the area. If it rejects that level and start dropping, that is your cue, right? Don't chase it, don't guess it. Wait for the market to show its hand, then step in. So the 200 moving average is a simple way to help you to figure out which direction to trade. Let's be honest, sometimes it's not always clear. No indicator is perfect. There is always pros and cons, right? So for example, with the 50 period moving average, right? If you wait for price to go to the right spot, it might move in your favor without you being in the trade itself, right? The same thing can happen with the 200 moving average, right? Sometimes you look at price on the daily chart, it might not be as easy to tell you what to do itself. Let me return to the examples from earlier. When I use the 200 moving average, here's what I do. I keep it on the daily time frame, right? Because it cuts through the noise, it gives me a crystal clear view of the long-term trend. So I always set it to the 200 period moving average. I mean, it's reliable, it's simple, it keeps me focused. If price is below it on the daily chart, I usually look to sell. But if its price is above the swing highs and goes above the 200 period moving average, it shows strength, meaning what? It's time to buy instead of sell. So I'm no longer blindly following moving average. They lag behind price. When the trade setup clashes with the long-term moving average, listen up, what do? I trust the price action first. Price action comes first. The market structure tells the story in real time. The moving average just follow the past. So when you are in doubt, follow price action. Price is at what? Support. Above is the resistance. Price is below the 200 moving average on the daily time frame. If price is below 200 period moving average, that's a bearish signal, right? But hey, it's not an automatic sell. The real game changer, price action. If a strong support level holds, buying could be the smarter move. So you want to trade with the context of the market, not just based on a single indicator itself, right? If price reaches a support level, I would buy it even if it's below the 200 period moving average. So the 200 period moving average is just a guide, it's not a rule. If you are new, it helps you to spot the trend. But here's the truth, the market structure matters more. So when the two are in conflict, trust the market structure. Price action tells the real story, and that's where the smart decisions are made. When price is below 200 period moving average on the daily chart, indicates a downtrend. In this case, we are looking for what? Selling opportunities, right? The market is going downwards. On the daily chart itself, this zone is near the resistance. That's where the battle begins. Price could bounce or get rejected hard because why? It lines up with the 200 period moving average, right? It's like extra confirmation, double the strength, right? So when key levels and major indicators align, this is what? It's not coincidence. This is called confluence. So this is where the smart traders will pay attention. Then I make my trading decision by focusing on the bigger picture, the daily and the 4-hour charts. The daily chart is like the compass, right? For the long term. But here's where the traders get it wrong. Moving average, they are laggy. They cannot think. They only react. So sometimes the market structure and the moving average, they don't align. So that's where the most traders panic. Like, what am I going to do now? They second guess themselves, right? And then they get shaken up of good trades. No. That's not what we do. Trust the market structure over the period moving average. Because why? Moving averages lag. They are like a slow GPS. They're like route recalculating after you have already made the turn upwards. They're like, it is going up. They lag. So the market structure, on the other hand, is the real-time roadmap. It tells you where the price is actually going to week itself, right? This is how I stay ahead. And that's how we trade with confidence. So there we go. Let's sum it up. Most traders, they misuse the moving average, right? Now you know, right? Here's how to do it right. Number one, forget all the crossovers, right? They lag behind price action. Use moving average as a trend guide itself, not a signal. Number two, identify strong markets. So compare trends using moving average to find the strongest vehicles out there. Number three, trade from areas of value, right? Wait for price, be patient. Patience is not just a virtue, it's an edge in the market. Wait for price to pull back near the 50 period moving average or whatever that you have set. Number four, you can use the 200 period moving average for the direction. It's like the compass of the bigger direction, the bigger trend in the higher time frame. And number five, market structure precedes, is stronger than the moving average. When in doubt, trust price action over the indicators. So thank you so much for watching. If you enjoyed this video, please give it a thumbs up, right? It really helps to keep the channel growing. And if you are new here, don't forget to hit that subscribe button and turn on the notification bell so that you never miss an upload. So we also love to hear from you, right? Drop a comment below and let us know what you think or what you'd like to see next. I mean, your support truly means the world to us. It keeps us motivated to bring you awesome content every week. And if you're keen to learn more, I created a free 5-part comprehensive training where I show you exactly how I trade using my lifestyle method. Link in the description below.